Happy New Year. This is Doug Gerlach, president of ICLUBcentral. Welcome to our Lunchtime Stock Club webinar. Today is Tuesday, January 9th, 2017, our first Lunchtime webinar of the new year. Hope you all had a good holiday season and celebrated the new year in fine style. Today we're going to take a look at where we stand in the market year to date and take a look back at 2016. I'll be talking about my favorite books of last year, and we'll also take a look at some words of wisdom from Charlie Munger, and then we'll wrap it up with a little tutorial on real estate investment trust investing. That's something that we get a lot of questions about, how to invest in REIT stocks and what do you need to do in Toolkit to accommodate them. So we'll be taking a look at some advice there. Today is Monday, not Tuesday. Thanks, Gene. It's a hard start for the week, for sure. Back to work, really, for many of us. But yeah, today is Monday, January 9th, not Tuesday. Thanks for that. Before we begin, welcome, and if you have technical problems at any point, I remind you that GoToWebinar.com will provide technical support for this and all of the ICLUBcentral webinars if you call them on their toll-free number or visit on the website. We also recommend that if you are having audio problems in particular, that you make sure that you're not running unnecessary programs on your computer. If you can connect using a hardwired internet connection, that will always be faster to deliver the audio and video components of the webinar. And you can always listen using the telephone if you need to dial in, and that will free up your computer to display the video component. If you have a question, you can type it in the questions box in the GoToWebinar application, and I'll be monitoring that and answering your questions as we go. The handout for today's presentation is also there in the Handouts tab of the GoTo application, so you can click on that to print it, save it, and you will be able to make notes on it, print it out quickly, save it for future reference as desired. The complete schedule of upcoming webinars is available on iClub.com in the Learning tab. Look for the webinars link there to find our upcoming schedule, as well as our list of archived webinars and handouts, also linked from those archived webinar links that you'll find there on iClub.com. As a reminder, tomorrow on Tuesday, January 10th, is our special My Stock Prospector webinar. If you have not registered for that and you would like to, you can use that link on the screen, and I'll also send that out via the chat function to everyone so that you can visit and sign up for tomorrow's webinar. We'll make that available as well. It's really designed to get you started using My Stock Prospector from a beginner mode all the way up through some advanced tips that I'll be demonstrating during that webinar. My Stock Prospector is the best screening tool that you can use if you are a better investing toolkit style investor. It'll really help you fine-tune your searches and fill in the holes in your portfolio. It's a powerful tool, and our education here is meant to help you get the most from that subscription-based application. Finally, you can like us on Facebook at just searching for ICLUBcentral. You'll get links there to our archived webinars when they're available, special notices, occasional offers into your Facebook feed. So we suggest that you follow ICLUBcentral there on Facebook. If you are in an investment club or are an investment club treasurer, our federal tax printer is just about to be released. We're finalizing the user guide today. The IRS released the last form that we were waiting for last Thursday, I believe, so we've updated our program. So we're going to be releasing that in the matter of a few hours, I hope. So that will allow you to get that federal tax printer forms generated in advance of the new earlier deadline this year. Reminder that clubs must file by March 15th this year and all years going forward, not April 15th as in the past. Next week on Tuesday, January 17th is our club webinar on preparing the tax forms. So that's a must-see for new treasurers who are new to the process of preparing the club's tax return, Tuesday, January 17th. And then on February 21st, we'll have our tax clinic where you can bring your problems, and that will still help you meet that March 15th deadline there. Now, let's take a look at where we are in the market. First, where we ended up last year, I think way ahead of every prognosticator at the beginning of the year, looking at corporate earnings performance and the performance of the S&P 500. On this graph, the blue line is the S&P 500, the green line is the Russell 2000, and the magenta line is the EFA, Europe, Australasia, Far East Index. So that is global, large cap, non-US stocks in developed countries. The Russell 2000, of course, the small cap index in the S&P 500, the broad, large cap index in the US. And you can see there, I'll point out over on the left side especially, the big drop that we had in February. If you recall, it was quite a big drop that the market had. The small caps actually went into a bear market. Oops, let me go back. Went into a bear market during that during this period over here, down 20%. And then as you look over on the right side, you'll see that the small caps were up 23.3% year to date. And that was really closer to 30% from the bottom of the small cap market in February. Large caps, the S&P 500 up 12.95%, and the EFA index up just 2%. Well off its highs set back in 2014. And that's what we expect to see, that when the U.S. markets are doing well, the global markets, the rest of the developed world tends not to, and vice versa, which is why I like to, in my retirement accounts where I am holding index funds, split up between these three market sectors to capture some of that additional non-correlation of the international and U.S. markets. I will say that with the S&P 500 and the small cap markets so elevated, that's been great for the performance of those indexes. Right now, I am going to be moving my regular allocation in my 401k for new money coming in to overweight the non-U.S. markets, the global markets, the EFA index in particular, to capture some of the performance that I expect will come at some point as those markets kind of tend to normalize, and as the U.S. markets, I think we've had a good run. Whether or not it continues for this year, there's just a lot of uncertainty, I think, still in the market. The economy is strong and continues to perform, but now expectations are very, very high as we look at where we are in the year to date. So just in the first few days of the market of 2017, you can see the Russell has come back down. It's essentially flat, down 0.1%. The S&P 500 up 0.67% from the end of the year, and the EFA index up 1.5%. And again, I think that's just a little bit of normalization from where things were at the end of last year. Really, there are no trends here, but this is just where we sit. So not a whole lot of adjustments from the end of the year, and all of that optimism that came post-election that seems to be driving the market upward. But if we look at the fundamentals, the S&P 500 PE ratio at 26.15, and that is just a little bit higher than it was in December. The S&P 500 PE ratio in December at our webinar was 26 exactly, so now it's 26.15, but earnings have not moved, so the PE ratio is high and getting higher, earnings. However, there have been no S&P 500 companies reporting since December, so that number remains the same, the trailing 12-month earnings at 87.17, which is down from the all-time highs that we reached about a year ago. So earnings still pretty soft for corporate America. See a lot of cost cutting and efficiencies being squeezed out of the system. The economy certainly performing better, which is raising some expectations. But here we sit with the PE ratio of the market at nearly an all-time high, and you can make an argument if we go back to that PE ratio screen that is pretty elevated. If we take out the 1990s peaks, if we take out the obvious outliers of the 2008 period, then you can see that we are at a PE ratio that is much higher than it's been in all of the market's history, going back to the 1800s. And even the declines when the PE ratio dropped barely below 15 in the 2011 period, even that was still much higher than much of the normalized range of the market in the last century plus. So I think, not unexpected with interest rates still low, and even though there are signs now that interest rates are going to climb and have been bumped up already, and they're going to continue to rise, still they're just not very enticing rates. Even if we get to 1%, there's still going to be a perception that better returns are available in the market. So I think that continues to bode well for the market altogether. Bonds just not delivering the returns that many investors are looking for. And so that's going to continue to provide support for stocks going forward. And of course, over the long term, though, we need to see company performance continue to improve. We need to see companies that are profitable and delivering growing profits in order for the prices of those large cap stocks to rise. So we come back to our earnings chart here. We want to see this driving forward this year for those large company stocks. And again, there's nothing that there are no bumps on the highway that are evident at this point. But as with all things, there's no certainty in the near term about where the market's going or where corporate earnings are going. But it was a great year last year for investors in general, ending the year on a very strong note, and it's going to be hard to beat that performance this year. I don't think anyone expected small caps to perform as well as they did, up more than 20%, given the strength of the economy, which tends to favor large company stocks over small caps, where we are in this phase of recovery. So again, that uncertainty is to be expected. There's just no way that we're going to predict where we are, where we're going with any degree of certainty. So we're going to continue to look out towards the horizon, look out using our 5-year perspective when we know that it's likely that even if we have a bear market, even if we have a recession, that those will be ended, and we'll be continuing to see companies on their upward march of earnings growth and the resulting price appreciation. So we can continue to search for good companies at reasonable valuations, as we always do, recognizing that the reasonable valuation definition just gets harder and harder for us to reconcile with all of the available stocks. Just the demand for equities is just so high that it's hard to find those companies that we like at what we would consider to be reasonable valuations. So we continue to try to dig and search and do our research and identify those companies as best we can. So we talked about Charlie Munger in the past, and I'm returning to to Charlie Munger's wisdom today. Charlie, of course, is the vice chair of Berkshire Hathaway and often the foil to Warren Buffett's wit and humor during annual meetings and in commentaries. Charlie's been pretty active in terms of expressing his viewpoint and his opinion. And there was a book that I read last year that collected much of his words of wisdom called Charlie Munger, The Complete Investor by Tren Griffin. And it's interesting that Charlie acknowledges the disconnect between the notion that anyone can be an investor, but also with the idea that investing really is not easy to do. As he said, the idea that everyone can have wonderful results from stocks is inherently crazy. Nobody expects everyone to succeed at poker. This is a really interesting idea that we talk about at Better Investing, the notion that anyone can be a successful investor. But Charlie points out that it is not reasonable to assume that everyone is going to necessarily be successful at it. Now, we believe that if you follow a consistent set of principles, that you can remove a lot of the uncertainty that comes from investing in stock markets and provide some measure of rationality to the idea of investing, and that we're not seeking returns in a short-term period. We're not looking at 1 year or 2 year or 3 year gains. We're looking out towards the long term. So our definition of success is going to be different from other investors in many cases. But Charlie pointed out that if investing weren't a little difficult, everybody would be rich. And it's actually, this is a thought that was in the original, or one of the Better Investing handbooks back when it was known NAIC. Tom O'Hara and Ken Janke pointed out that if everyone was, if investing was easy, we'd be a nation of millionaires. And the fact that we're not has to do with I think the fact that people have misguided notions about how to invest in stocks, and a lot of the misinformation about stock market investing has been perpetuated by the financial industry over the years to keep people out of the do-it-yourself sector and to drive them into the eager waiting hands of financial advisors and stockbrokers who will, for a fee, give you the guidance that it would be impossible from their perspective for you to undertake without them. But I think Charlie's point has a lot to do with the notion of understanding the limitations of investing and our own skill set, our own expertise. At another time, Charlie talked about having 3 piles into which stock ideas are sorted, investing ideas are sorted. One is yes, another is no, and the other is too tough. And that is kind of interesting. Yes is obviously the smallest pile. These are the ones that we have a very clear idea of. We have insight, we believe, and that we think that we can make good decisions about. The no pile is enormous because most companies are not going to fit our approach. But that too tough pile, that's the one where we separate out the companies that we have a feeling about, but we don't have a whole lot of confidence about. We're not quite sure about those companies. And I think that speaks to the limits of our own expertise and experience. Charlie also talks about the notion of investing as something that you can improve on the more you do it. The longer that you invest, the more skill and experience you gain, which in turn creates better opportunities and gives you better results. And I think that's a consensus that many toolkit users and Better Investing members would agree with, that the more you do it, the more you learn, and that you never know everything that you need to know. You know enough to get things going, and I think as you understand more about the market. You understand what you can safely ignore as noise and what you can implement on your own into a successful investing approach, and that you can make better and better decisions. If you haven't lived through a bear market, it's hard to describe how you're going to feel or understand how you're going to feel or describe. We can tell you, we can give you guidance on what to do. Other people can instruct you, but until you've lived through it, and then once you've lived through it a couple of times, you really begin to see the advantages that come from a long-term approach in the market. So I think, Charlie's, it's always good for us to think about our limits and limitations. Warren Buffett and Benjamin Graham have talked about having your kind of your own sphere of expertise, acknowledging what you're good at, and using that self-knowledge to deliver better results in your portfolio. And I don't mean that we have to go out and some of us are sector experts on particular industries or sectors, but really that we understand that we do have biases. Maybe you realize that every once in a while you have a tendency to get too excited about a new idea, and it's better if you wait a month or two before you click the buy button and take a position when you find a new stock, or you have some other self-checks in place. And again, that's all perfectly normal, and it doesn't mean that there's a flaw in our approach, but just that we acknowledge our inadequacies in many ways. And that's a sign of intelligence. There's a lot of psychological research that goes into identifying why people make ridiculous decisions sometimes, thinking that they are completely in the right and that they know more than everyone else. And the people who believe that they know more than anyone else generally are the people who score lower on intelligence tests and have less flexibility in dealing with life decisions. So I would just caution all of us to acknowledge our limitations and not get swept up in the mania that much of the market is designed to propagate over time. Anyway, enough on that. Let's talk about some of the books that I read last year. Just a little kind of quick overview. Many of these I mentioned during our webinar, but I went through my list of books from 2016, and I pulled out some of the top picks that I liked in the investing, business and financial, self-help, technology categories. So here's about a dozen books, 10 or so books that I thought were really interesting. The first is one that I read late in the year called Business Adventures by John Brooks. And this is a reprint of a book that was originally published in the 60s, I believe. And John Brooks was a reporter for the New Yorker and other financial publications, and in the 50s and 60s. So he was taking a look at some of the stock market crashes that happened early on in the 60s, for instance, and how the market responded to those prior to the kind of supercomputer era, and what was going on with ticker tapes and how trades had to be manually entered at the end of the trading day, and that is just kind of an interesting framework that showed that some of the same factors that force market corrections and drops today were already in effect, 40, 50 years ago. He also talked about, there's a fascinating chapter about the history of the Ford Edsel automobile, how it came to be, how it became one of the biggest flops, but all of the factors that went into and the management decisions that fueled the development of the Edsel. So I found it a very interesting book. Historically, it was sometimes hard to remember that this is a book that was written 40, 50 years ago because the lessons in it are still so relevant today. Book number 2 is The Cheapskate Next Door. I talked about this book at our last lunchtime webinar about people living below their means, and I thought it had a lot of great information and advice and guidance for people to think about living in the age of overabundance, what we can do to counter that. Dataclysm, Who We Are by Christian Rudder is an interesting story about how computers and technology and the internet today can create profiles of us by what we would consider disparate points of information and data. Working with a dating website, they were actually able to construct profiles of people that went way beyond their mere proclivities for a dating partner. But I think it certainly has implications in an age where anonymity is getting lost, to understand how data is being collected and used is kind of fascinating. The next book, The Physics of Wall Street, talks about the use of science and mathematics and to predict the performance of the markets. Talks about a little bit about flash trading and its implications. I talked about this book, and I think it's pretty really interesting, fascinating read. Better Than Before, Mastering the Habits of Our Everyday Lives by Gretchen Rubin is a follow-up to her book on happiness, and it's I just thought it was a terrific book that kind of crystallized some thoughts on what we can do to help make our personal lives a little happier by the use of habits. And I think the habit of investing is something that one way that I would characterize what we do as individual investors. The habits of saving and investing are not something that we do unconsciously, but they're something that we need to practice and we need to implement. The Everything Store, Jeff Bezos and the Age of Amazon by Brad Stone is just a story about Amazon, and Amazon is just such a factor in our economy, in e-commerce and commerce in general, just really how it's changed the way that we shop for goods in many cases. And so this is the story about how the company came into being. Charlie Munger, The Complete Investor by Trent Griffin is, again, a terrific read with lots of homespun advice from a great investing mind. There's a lot in the book, of course, about the whole school of value investing, a la Benjamin Graham, but much of it is also applicable to our style of investing. 10% Happier, How I Tamed the Voice in My Head, Reduced Stress Without Losing My Edge, and Found Self-Help That Actually Works by Dan Harris. Dan Harris was a television reporter who had a breakdown on the air, driven by stress, and ultimately he found meditation to be a means for him to work through the stress. And so it was interesting, a very self-deprecating story of someone who really was very close to falling off the edge of reality, but pulled himself back and learned a whole set of skills that changed his framework and how he interacted with the world and the people around him. The next two books are Bitter Brew, The Rise and Fall of Anheuser-Busch and America's Kings of Beer, and Quench Your Own Thirst, Business Lessons Learned Over a Beer or Two by Jim Koch. The Bitter Brew, the story of the rise of Anheuser-Busch breweries, the makers of Budweiser, and the subsequent decline of it by the time it reached the last generations prior to the sell-off to InBev, to create InBev. Just a fascinating business story about the perils of nepotism in the business world, these closely held companies in many cases. The generations that take over them are not prepped at all and don't have the drive and determination of their forebears. So I think it is a tragic story in many cases, but I think if you own InBev, you owe it to yourself to read this book to understand how Budweiser got to, and Anheuser-Busch got to where it is today. And then Jim Koch founded Samuel Adams Boston Beer Company and Samuel Adams Beer. And so this is a different story. This is a story of the ascendancy of a brewery in the U.S., an independent brewery when there were very few independent breweries around, and how he came to be successful. It aims to provide a lot of business lessons, but I found it mostly interesting for the story of how the Boston Beer Company grew to be the company that it is today. And then finally, a book from a couple of years ago that I finally got around to reading, The Checklist Manifesto, How to Get Things Right by Atul Gawande. He's written a couple of books. He's a doctor, and The Checklist Manifesto came from some work that was being done in hospitals, in surgery rooms in particular, where they were able to increase the mortality of patients in a surgical wing by the use of checklists, where they would go through, instead of relying purely on the knowledge and experience of the doctors and the attending nurses and other staff, when they created checklists that they would go through, and they didn't have to be extensive, but these checklists helped them to decrease mortality and really improve the results in that hospital situation. And many of those lessons can be adapted to other fields, and certainly in investing, many of us have checklists. Better Investing has a stock checklist. We talk about things to check, 10 items to check before investing in the stock, etc. And I suggest that clubs and individuals develop your own personal checklist. What are the things that you want to confirm? And it's just that framework, even similar to the stock selection guide, performing as a checklist, can help us to overcome biases that we have and make sure that we're not missing out on important areas that we should be focusing on before we make a big investing decision. So I think it's not a very long read, and I highly recommend it. So those are some great books that I read in the last year. I see Al recommends The Power of Habit by Charles Duhigg. Speaks to habits as well. I think that's a great topic, and I will make a note of that, add it to my reading list. I did read 258 books last year, the same as I did in 2015. And that's my goal is to read 250 books a year. I've done that since 2011. So I'm just trying to get through my reading list and absorb as much knowledge as I can, and certainly enough of those will be business and investing, technology, self-help books that I hope to share with you in upcoming lunchtime webinars. As I mentioned, we're going to talk today about REIT investing, real estate investment trusts. Last month during our webinar, I took a look at Crown Castle International, which is a real estate investment trust that operates communications towers, which they lease to mobile carriers and other wireless data providers. We've focused in the Investor Advisory Service. We follow a couple of real estate investment trusts in the Small Cap Informer. We cover a couple of real estate investment trusts. So I thought, and I've written about them, but I thought I would just do a little tutorial today to go over some of the things that we look at when we're investing in REITs and give you some guidance on real estate investment trusts. Real estate investment trusts, we call them REITs. They're abbreviated REIT, and that's a pretty standard definition, but it is a special classification of companies that company that owns and or operates income-producing real estate. And that can be apartments, shopping centers, offices, hotels, warehouses. Could also be golf courses, could be medical centers. We have REITs that specialize by area of country as well as type of real estate, such as these. There's also mortgage REITs that engage in financing real estate, and those are a little bit different, and we tend to stay away from those because they're not really, they don't really have an operation that's easy to identify and analyze. But the interest in REITs comes from the provision under U.S. tax law that gives REITs significant tax advantages, and the idea is to stimulate investment in properties. And so there are all sorts of, there are more than 150 publicly traded REITs and more than 1,100 non-public REITs, which is something that people aren't always aware of. You can have a real estate investment trust with a smaller number of investors that's not publicly traded and still get the benefits of holding a real estate investment trust. REITs trade on stock exchanges, but they are not what we would consider common stocks. There's a trust in the title. And that is our clue that these are not operating companies, but investment trusts that operate businesses within that trust structure. When we talk about REITs, the advantage is that dividends that are paid out to shareholders are deducted from corporate income taxes, which is to say that real estate investment trusts do not pay corporate income tax as long as they meet the couple of provisions. So as a result, most REITs are remitting more than 100% of taxable income as dividends to shareholders, so they don't pay any corporate income taxes. And you may be asking, how do they remit more than 100% of their taxable income? And we'll talk about that in just a couple of minutes. In order to preserve that tax status, REITs must pay out at least 90% of their net income as dividends to shareholders. So that means they're not retaining, they're not allowed to retain a lot of earnings to fund future investments. So that's going to drive them into raising capital by issuing shares or by borrowing money. And most will do a combination of both of those. But they've got to keep paying out at least 90% of their net income on a regular basis. And 75% of their income comes from real estate related businesses. It's been a movement that started, a little mini movement last year, where some companies that were highly involved in real estate started to convert to real estate investment trusts. And again, if you think about what do we mean by real estate related businesses, you know, companies like McDonald's are huge landowners, and the fact that they operate, they then lease those spaces, in many cases, their real estate, to franchise owners who operate the restaurants. So in theory, some companies like that could restructure as real estate investment trusts and not pay corporate income taxes, and then share a higher yield with their shareholders. So there is a movement afoot for many companies that kind of fit into that model to shift over to real estate investment trust status. As I mentioned, there are a couple of types of REITs. There's equity REITs. These are the ones that buy, sell, manage, renovate, develop real estate. They're buying property. They may buy land on which they're going to build property. They'll buy land and then build a shopping center and then lease out the stores in the shopping center to other businesses. I think a good portion of shopping malls and shopping centers these days are operated in this fashion. The operator would be a real estate investment trust. The mortgage REITs are ones that make and hold loans and other obligations. They're secured by real estate collateral, so the idea is that these loans are relatively safe because they're backed by a hard asset of real estate. And then there are hybrid REITs that do both. As I mentioned, we tend to like the equity REITs because it's just a little easier to get a handle on their operations. We know what their portfolio of businesses is. We know what their occupancy rates are, so that just makes it a little easier for us to analyze them from our perspective and our preference as stock investors. Here, just to give you a sample of the kinds of equity REITs that are out there. So these are by property type, and you can see all of the different categories: shopping centers, regional malls, apartments, manufactured homes, lodging and resorts, self-storage, healthcare, timber, infrastructure, home financing, commercial financing, office spaces, industrial, and mixed. So it's a pretty broad category of just about everything having to do with real estate can be wrapped into a real estate investment trust. So why are we investing in REITs? Well, when you compare REITs to real estate, REITs are liquid. They trade on a stock exchange. That means you can buy and sell your REITs throughout the day. If you need cash, you can sell your REIT shares instantly during the trading day. If you own real estate and you need cash, well, you're not going to find necessarily a buyer right away. And if you are really driven to sell, you're probably not going to get the maximum value for your property. So real estate is not what we would consider a liquid investment at all. REITs have a low correlation with stocks, which means that they often go counter to the stock market. They won't rise as fast during bull markets, but they won't fall as much during bear markets. And so that can be good to add diversity to your portfolio. The REITs were recently, last year, at the end of last year, added as a major sector to the S&P 500. Prior to that, they were considered financial stocks, but the importance of real estate as a sector has been brought to the forefront with this change by Standard & Poor's. But I think that real estate should be part of just about every individual investor's portfolios because of that diversification. And you know, if you had had the foresight in 2008 to invest a lot in real estate investment trusts at the bottom of the real estate crash, the returns over the next few years had been really phenomenal as that sector corrected and recovered. Another reason we like REITs is that they're transparent. They have to report to the SEC every quarter, once a year, and provide material news, just like common stocks. So they've got that in common with companies. And so again, that means that we get to see how the companies are performing. We get to see the underlying data that drives our fundamental analysis. REITs provide current income. REITs have become very popular in the last few years as interest rates have continued to decline because of those mandatory payout rules. REITs tend to be the highest dividend payers on the stock market or on the markets as all. This graph from 2011 shows that REIT index on top in the light green with the yields much higher than 10-year treasuries, 1-year CDs, or even the S&P 500 as a whole. So if you're looking for income, REITs are one component that you can add into it. But we as better investing investors like that REITs give capital appreciation as well. They really are total return investments. They give you high dividends plus moderate long-term capital appreciation opportunities. And when you add those together, you can get a pretty good rate of return. Of course, those real estate investment trust dividends are going to be taxed at your ordinary income rate. But you're going to pay a little bit of taxes, but that you'll have less in capital gains from the capital appreciation when you eventually sell. So it's a little of you pay the taxes now, you pay them later. So that is something in your non-taxable accounts, your IRAs, etc. REITs can be great when you don't have to worry about the taxation. That can be a good component of them. REITs allow you to target your investments by sector. retail, residential, industrial, hotels, hospitals, etc. by region. If you believe, like many investors do, that the South has a lot of growth opportunities for real estate as people continue to retire there, for instance, maybe that's one way that you might target your REIT investment, your real estate investment dollars, and then by size, smaller companies, mid-sized, and large companies as well. Certainly when compared to real estate, owning physical property where you've got to deal with repairs, maintenance, insurance, occupancy, capital improvements, financing, etc., REITs are clearly a lot easier to deal with. Your REIT will never call you at 3 in the morning to complain about a plumbing problem or the heat going out. REITs let you benefit from the ownership of real estate without having to worry about day-to-day management. Now, there are some disadvantages of REITs. REIT distributions can include returns of capital and capital gains, so that complicates bookkeeping. And so that can make things a little more complicated when you're filing taxes at year end. Those distributions are not always purely dividends. They include many different components. And because of that, we don't recommend REITs for investment clubs just because of the additional difficulty. Now, in terms of problem securities for clubs, REITs are pretty mild. It means that for every REIT, you probably have to edit your quarterly distribution entries and recategorize them and do a little math to figure out the percentages that the REIT reported at year end on the 1099 div, and then go from there. But if any of what I just said made you scratch your head and go, huh? Then that's a reason to stay away from REITs in an investment club. It's not a problem for individual investors that because we're not worried about capturing the quarterly distribution allocations, but for clubs we have to. So we've got to do some make work in order to make it work out for us. So when we're analyzing REITs, we need to take a couple of things into consideration. And one of them is management. Of course, we're thinking about management, and we want to look to management in the same way that we look at management for our operating companies in our portfolio. We'll compare REITs to other REITs of the same size and in the same particular focus, making sure that we understand how those REITs are growing the company, how they're profitable. And we can also look at management's ownership. In many cases, you'll see higher levels of insider ownership with REITs than with other companies. We like to look at things like the growth of the company, revenue growth certainly. And while earnings growth can be important, we're going to focus on something called funds from operations, FFO, and funds from operations per share in particular. And the main difference there is that the funds from operations figure is determined by using net income before depreciation and amortization expense is deducted. Depreciation and amortization are non-cash charges and expenses, and so the idea is that we're gonna take out those non-cash items to get the resulting funds that were generated from the operations of the business. The reason we do that is that real estate usually doesn't depreciate in value. If you're buying real estate successfully, it's going to appreciate. But on the books, we're going to depreciate it. We're going to write down the value according to accounting principles. So when we take out that depreciation from earnings, we actually are misrepresenting the actual amount of money that the company is generating. Not all properties appreciate in value, but many of them, most of them aren't going to depreciate, at least over the long term. Another reason is that owners have to account for costs associated with the structural improvements, the capital improvements that they're making to maintain value. And when we add back depreciation, we're providing an overly positive outlook for the property. So we like to look at funds from operations, and we'll report that. We'll actually replace earnings per share with funds from operations per share in our quarterly and annual reporting, and we'll look at FFO as if that was earnings per share. And that will give us a clearer sense of the company's performance. If we look, here is a real estate investment trust, and you can see sales, pre-tax profit, and earnings over the last 10 years. So you see that decline in earnings per share in 2010, and then recovering in 2011. Here's the same company with funds from operations per share, and we took out the pre-tax profit. This particular REIT doesn't have a lot of taxable pre-tax profit, taxable operations that we have to worry about, so we're only looking here at funds from operations, and you can see that the decline in actual funds that the company generated did not really go down very much in 2010, even though on the books earnings showed a much bigger drop. And so we're getting a slightly different perspective, but this fits the long-term approach of better investing, and so we really like to do that. Now, on the StockCentral and Better Investing side, we are looking at adding funds from operations, providing that data in some fashion. That's a change that our data provider Morningstar made last year. So we're working through how we might be able to do that, and that would certainly make this process a lot easier. Now, if you want to study a REIT, you'll need to historically go back and manually change earnings per share to funds from operations per share. And I will make a note that as you do that as you do that replacement in Toolkit, all of a sudden they're no longer PE ratios, but what you might call PF ratios, price to funds from operations ratios. And again, because we're looking at the comparative value, that's okay. It doesn't really matter that it's not PE, but that's the change of changing the E in Toolkit to the F for funds from operations throughout. When we're looking for management, we always want to look for managers who are aware of market conditions and are willing to add properties as they can. We don't want to find managers who are just looking to make deals. We want to look at or looking to add rents or income. There are a couple of shortcuts to looking at management. We can check their financial ratings, and we can look for those that have lower, higher interest rate coverage, and paying lower interest rates. The financial ratings. The lowest rating before junk status is BBB, BBB minus. Value line financial strength should be at least B for these kinds of companies. Those are two quick ways that we can check management. Payout ratios often are a source of confusion when you're looking at real estate investment trusts because payout ratios commonly exceed 100% of earnings. Now, for many operating companies, common stocks, we don't like to see payout ratios exceed 50%. And for utilities, that's very common. We might see 50% or more of earnings being paid out to dividends. But for REITs, you'll see payout ratios that exceed 100% of earnings per share. It won't be 100% of funds from operations, but if you're looking at earnings, you'll see payout ratios that are very high. But the lower the payout ratio, the greater the amount of cash the REIT is maintaining. But remember, they've got to pay out a certain percentage of their cash every year in order to maintain that tax advantage status. If the payout ratio is too high, that could indicate a dividend reduction. So if you're focused on income, you might look for REITs with higher payout ratios. For growth, you might look for lower payout ratios. And here in Toolkit, you can see using earnings, you'll see these payout ratios of 197, 211, 106%, et cetera. But remember, that's being paid from net income. there are all that non-cash, those non-cash charges that have reduced net income, so it's not being paid, reflecting the cash. There are other things you can take a look at for REITs, including the debt levels, ownership, including insider ownership, and the capitalization ratio is something that many analysts look at. We don't have time to take a look at those today, but if you want to know more, we can address it in a future session. A couple of questions. Carolyn asks, do you only file income tax returns in your home state with a REIT? Yes, you have to. It's only your personal returns. You don't have to file in multiple states like you might with an MLP. So you don't have to worry about those types of rules. Gilbert said, can REITs be bought in IRAs to avoid the ordinary income payment? Yeah, I don't think there's a problem with holding your REITs in an IRA or a tax-advantaged account, and that might be a smart thing to do. Smart thing to do if you were didn't want to have to worry about the tax bill each year. Stephen says, comments on REIT ETFs. I think an exchange-traded fund that invests in real estate investment trusts would be a fine way to invest in REITs if you didn't want to do the work and you wanted to get some diversification. I think an index fund, there are index funds that track the real estate segment and the various components, so you can kind of drill down. I don't have any recommendations as to particular REITs, but you could certainly, not too hard to find, and that might be, again, something that you might consider in your 401k to help you diversify a little bit into real estate if you wanted to get a little further into that. Kathleen says, what are the pros, cons of holding REITs in ETFs instead of directly? Well, obviously, when you're holding an ETF, you're going to own and be impacted by the performance of a number of real estate investment trusts. So similarly, as we as individual stock investors like to focus on the best of the best, an ETF would own the best of the best, but also include the worst of the worst, because it includes a broad spectrum of companies. So, you know, you give up the chance of outperforming the index by owning an ETF instead of owning a REIT directly. But otherwise, the taxes, you're still going to get your distributions. There are some distributions like Realty Income, the ticker symbol O, that pay out monthly. They're designed to be an income-generating vehicle for investors who want the very current income, not even quarterly dividends, but monthly dividends. But your real estate investment trust ETFs are going to pay out, make those quarterly distributions in most cases, and so you're still going to have the same components of capital gains and dividends and other returns of capital that are going to be distributed from the REITs into the ETF and then out to you. Walter says, if REITs pay out the majority of their earnings, how do they grow? And just to kind of emphasize, if we go back here, the payout ratio doesn't mean that these companies are borrowing to pay the dividend. It means that the net income that's reported according to accounting rules has been reduced due to depreciation and amortization, non-cash adjustments. But the cash is still there. We're just writing down the value and taking charges against them. And so the notion over time is that these real estate investment trusts, the value of the property they own, the book value on their books is very low because it's been depreciated over time. But if the company is doing its job, the value of that real estate is actually increasing over time. So just that's the difference of using funds from operations versus earnings per share in the analysis there. Tammy, that's a long question, and I don't think I have time to to kind of read it and analyze it, but I'll take a look at it after our session there. Hugh asks, do REITs generally have higher debt than stocks? Yes, real estate investment trusts are generally going to have higher debt than common stocks because they need to borrow money to buy property, to develop property, to make expansions, to upgrade facilities, etc. So they're going to be using cash quite a bit. That's helped them in the post-2008 recovery period to borrow money at very low interest rates. The best managed REITs with the highest quality ratings, highest debt ratings, were able to raise capital at very advantageous, attractive rates and expand as they go, as they get bigger. And thereby expand by buying more properties, by upgrading their existing properties. So certainly the debt levels are going to be much higher. So as always with debt, we're going to compare within the sector. We don't want to make the judgment that because a real estate investment trust has 60% of debt, 60% of their capital or equity is debt compared to 20% for another company, that the other company, non-REIT, is a better business. So we want to focus within the REIT sector and take a look at some of those capitalization ratios that I mentioned in the debt ratios. Remember, that's how they raise money. The other way is by issuing shares. So you'll see REITs doing a lot of issuing shares on an ongoing basis in order to maintain the capital that they need to expand there. Rita says, how do you research the IFA market? Well, the IFA market is an index. So this is a market index that's managed by, used to be Morgan Stanley. It was the Morgan Stanley IFA. So the ETF that I select is just based on that index. And that is Europe, Australia, Asia, and the Far East. So, and they are all large cap stocks for the most part in those developing countries. It's meant to be an index that represents the developed world outside of the U.S. That's the intent of that index. But those are the main drivers of the global economy, are those companies. It does not include developing countries in it. But if you look up IFA, E-A-F-E, or the Morgan Stanley IFA, you can learn more about that particular index. Steve says if I would demo the input of FFO into Toolkit. So yeah, I can do that real quickly. If we download a company, here's a REIT that we cover in the small cap informer, extra space storage. So here is the company. Here are the earnings per share. I'm going to click on the data tab, and then I'm going to click on annual data, and this earnings per share field here is what I'm going to replace with funds from operations. Now again, once I do that, the field is still going to say earnings per share here at the top. The E is still going to be represented on the graph. It's not going to change to F for funds from operations. So everywhere throughout the program, it's going to say, still going to say earnings per share and PE ratio. But once we change these earnings per share values, we will see the prices, the PE ratios will be calculated, etc. And we can do the same with the quarterly data over here. Replacing the quarterly earnings per share for the last 5 quarters here. And so I'll just delete those out. I like to do that before I enter the data by hand. And then the other way to go back even further, if you really want to build it out, if you click on the quarterly trend analysis, you'll get this report. If you click on this report, you'll get this screen, which allows you to click in and edit the earnings per share for each quarter. And again, this scrolls, so it'll go back a number of years, at least 5 years of quarterly data going back. And so then we'd reconstruct this all. Some REITs will provide a table of their funds from operations on a quarterly or annual basis. Others, you need to reconstruct all of that data from the, I like to look at the press releases and the financial statements or the SEC filings that have that information. Sometimes in the SEC filings, you will see a summary of the funds from operations in the non-GAAP section of the financial statements. Once you have made those changes, you will want to lock the data down here on the left. Lock that data, and that will prevent this company from being updated when you are doing an update process. So if we click on update, it tells us that now this company is locked and will not be updated. And that's what we want. We do not want to see this this company being overwritten after we hand enter all of that data. So to find those funds from operations figures, as I said, go to the company's website. You can get it in the quarterly and annual press releases and filings. They will report that out. Some of them have summaries of additional information that they provide with their press release that would include the funds from operations, but that's what you're looking for, funds from operations per share, and that'll get you to that information there. All right, well, I want to thank you all for dropping in today. We'll look forward to seeing you at our upcoming webinars and my presentations. I'll be at the Orlando Money Show in February, the Northeast Ohio chapter in April, the Better Investing National Convention in May, and I'll be down in Washington, D.C. at a AAI Better Investing Workshop in June. So those are the events I've got scheduled for the first half of the year. Hopefully we'll have the chance to meet you in person at one of those. As always, thanks again. I wish you all the best for a happy 2017, and we'll look forward to seeing you at our next Lunchtime Stock Club webinar.